we go into our underwriting for acquisition. There are some things that we are doing. And again, this is very, very market based, because one thing that has taught me that I learned this year was like pay attention very, very much to your city and your state's local policies when it comes to like landlords and stuff like that. You know, you hear those things like landlord friendly states or tenant friendly states. I never really paid too much attention to that outside of like evictions, like how long it takes to evict somebody. But holy crap, this last 6 months has been crazy. Like my Michigan portfolio is performing completely different than my Texas portfolio. So I'm paying a lot more attention to the local state level politics there and their policies to kind of dictate my lender or my reserves and my underwriting to what I can do, because that's guiding a lot of that.
All right, guys. Thank you for joining us again for another amazing episode. Today we have Vince Ghettings. Just a little bit about him. He is the man, the legend, our coach. He's our coach in Jake and GINO. We have huge amounts of respect for him. He has over now, I think, 5 million worth in assets. His company, Tri-City Equity Group. He has a team there, and they're completely crushing it. We'll go into some of their deals and processes that they use and to make it happen, because I mean, probably touch upon it, but you know, they have several deals in the pipeline, and yeah, we all want to get there. So let's roll. Vince, tell us a little bit, man. How did you, one is, how did you get started initially? How did you get in multifamily? And, you know, what was it through the program, or did you do it before Jake and GINO program? How did that work?
Yeah. So thanks for having me on.
Yeah.
It's great to be here and adding some value for your guests. But yeah, so how did I got started? So I don't know how much of your guests are military or veterans, but I got started with the VA home loan house hack is what I used. So I was stationed at Travis Air Force Base, Northern California. I got there around 2010. So like right as the great recession, house prices were down. We got ourselves into a small 1,000 square foot, 2-bedroom, 2-bath house in the Bay Area for like $130,000. I did a live-in flip. So me and my wife moved in there, had a couple kids, and was fixing it up as I lived in there. You know, did floors, did paint, did all the things as you're living there for 3 or 4 years. Got orders to PCS out. Sold that house I bought it for 150. I sold it for like 290 or something like that. So I walked out with a check for I walked away from closing with a check for $130,000 tax free
Nice.
Because it was my primary residence, right? So primary residence, I used that $130,000, and that's what I used as the seed money to invest in real estate. And at that time, my investment career was very much into stocks leading up to this. Just like a lot of military people, you know, we get deployed, we go TDY. You know, it's easy to get into stock trading just because all you need is internet access, and you start doing the day trading, the swing trading, things like that. I was big into ETFs, exchange traded funds, and trading those. So that's what I did. And then I started losing trust in Wall Street very quickly. I got burned a couple times just on companies. Not so much like me just being a bad stock picker, but the companies submitting false, like fake information to the SEC, like to their investors, like falsifying financials. And that happened right around the time that I was selling this house, right around 2008 or 2009, 2010. And, you know, I got burned for a couple grand. And at that point I was like, I'm done with the stock market, and I liquidated everything. So I took my 130 grand from the house. I liquidated my TSP, I liquidated my IRA, my brokerage accounts, everything. And I took all that money and went full-time into real estate. And at that time, all I knew was bigger pockets. Like most people, they usually, they start rich dad, poor dad, go down that rabbit hole, find bigger pockets, get on the forums there. That seems to be the most natural progression most people find themselves into. So I started reading all Brandon Turner's books, absolute gold. And at that time, I got into small multifamily, duplexes, fourplexes, things like that. I bought 20 units in about 18 months. So I went from one single family house to 20 units in 18 months, starting from $0 to that portfolio, 20 unit portfolio, in about 18 months. And then from there, I hit a wall pretty hard. This was about the fall of 2018. And like I ran out of capital. My cash flow was good, but my equity, my net worth and my equity, my deals wasn't increasing as fast as I thought it was. I kind of hit like a really hard wall. And I saw a bunch of my other people, colleagues and stuff like that in other podcasts as well. They just kept like ramping up operations. You hear guys like David Tupin and things like that, just crushing it. Like they weren't stopping. I was like, I'm missing something here. Like I got to figure it out. Like I know enough that they know something I don't. So I got to figure it out. So that's when I started looking into larger multifamily. And I got a bunch of lessons learned about the smaller stuff. I'll never do that again. But getting into the larger multifamily, interviewed with a lot of the big coaching groups out there and landed with Jake and Gino. So I was actually one of, Jake and Gino's like first round of students that came through in 2018 when they started that program. And yeah, that was 2018 in October. And to give credence to how well that program is, I had a 52 unit under contract by January.
That's awesome.
And I started in October, burned through the program like my life depended on it, because in my eyes it did. And yeah, had that 52 unit under contract, closed it in the spring of 2019, and haven't looked back since. Since then, I closed another 48 unit after that. Now we have a few other deals in the pipeline that we're closing this 2020 out with. So.
That's awesome, man.
It's
pretty awesome to see that, because I agree with you. I think after we reposition our portfolio of small multifamily and sell it, we would never go back to residential. Yeah. And if you can, touch upon that just a little bit, because, we always try to harp on it, the differences between the commercial and then that small multifamily, right, are huge. So
yeah, we can do the rest of the show on that, like all the things I did wrong. And it's not that I did wrong. It's that all the limitations I saw with the small multifamilies, the duplex and the fourplexes, and that a lot of people they never get like that light bulb of like, there's a better way to invest in real estate than this. And they just do years and years and years and years and decades of just trying to acquire duplex and fourplexes when they're just killing themselves on these smaller deals, when they can just get in the right mindset and jump to a commercial property, and their life will just get a lot easier.
I think the concept of commercial real estate scares people. The commercial is like, oh my God, I gotta be somebody huge to be able to do this. So I think that's what for me. I heard commercial, I was like, oh my God, I can't do that.
Yeah. When actuality, it's so much easier. You're dealing with a different side of the lending house. The loans are easier to get. They're not going on your personal balance sheet like a conventional loan does, things like that. The way that they're valued, like that's what killed me. One of my 4 units, I bought it for $170,000, put like 60 grand into it, went to do a refinance on it, a couple of years later, and the appraisal came back at $170,000. And I was like, whoa, like I put all this money into it, made the outside, full exterior renovations, full interior renovations, bumped the rents up $200 each unit. Like everything about this place is better. And they're like, that's fine, but there's no comps for this building in the neighborhood. Like you have the only 4 unit in this block. So I don't have anything to compare it off of. So it's worth 170,000.
Yeah.
And that was, so like on paper, I lost like 60 grand, and I had to wait till I sold the place. And that was my only way to capture that equity, was I had to sell the place in order to recapture that. And I actually sold it at, I pretty much broke even on that property because it was comp value approach. If that was a 5 unit and I crossed the bridge into commercial, I would have no problem justifying the new valuation because it goes off income, value approach. So, and I was like, that's just one thing I learned, like that,
that's what we learned too.
Yeah. Why?
Yeah. That's what we learned. It's not, that completely different things, man. But yeah, cool. So where you at now? So you're, you're I know. Still investing in El Paso. Where else? What are you doing?
Yeah, so we're in Michigan, mid Michigan. We're in El Paso. I'm pretty heavy in El Paso. I love El Paso, and we're looking at possibly the south, some of the southeast markets like the Carolinas. We might have some partnerships, blooming out there that we might be able to get into the Carolinas. So that's it right now. I try not to do a whole lot of different markets because it's to be an expert at a market and stay current that's a lot of work. So if you're trying to do like 10 different markets, you're pretty much going to be mediocre at all of them, just because that's so much information that you're constantly trying to stay updated on with that many markets, unless you have like a big team that's out there, like, kind of like a regional manager type setup where, you have employees that are focusing on each market for you. We're not that big yet. So I try to keep it to 2 or 3 markets and just be, laser focused and experts at those markets.
I hear you, man.
When you say that you have partners and this is for the audience that probably they don't understand, Jake and Gino, how the community, how tight we are and all that, are the partnerships that you're creating in those other markets are a product of the community with Jake and Gino, or is it just networking outside the community?
Yeah, both. So in Texas, that is a network from outside of the community. It was actually the Texas market. That was actually my property manager for my last deal that liked what we were doing so much that he came to us and said, I want to be your partner on the next deal. He's like, what you guys are doing is amazing. The way you execute your business plans. He's like, I want in. So my property manager is actually turning into our partner for Texas. So that's a win-win for everybody involved in that market. For the North Carolina or the Carolinas, what I was telling you about, that's very much from this community. Once I have a partner out here in Hawaii with me, and he expressed interest in the Carolinas, he's like, this is the markets I want to go in. Let's build a team there. Went to the Jake and Gino community and seeing who was operating that market, sent a bunch of emails, did a bunch of calls. And now we're, like I said, those conversations are kind of blooming into what will be a partnership once we get some deal flow there.
That's awesome.
That's nice, man. So tell us a little bit about one of the deals that you closed on the process for it that you went, because you're also full-time active duty and you leverage your time, very heavily. So how, and that's any person with a W-2 job. So how do you work through all that and still close? What processes do you have in place for that?
Yeah. So the last 2 is, let me think. The 50th unit we did as a JV. So 4 people, very simple structure. Everybody comes in 25%. Everybody does 25% of the work. And that was pretty much very, very straightforward process. For the syndication, a lot more work involved in that. So I rely heavily on building teams and processes and systems. So in my team, the way we set it up is I'm the COO, and I set up the business plan, and I set up the timelines, the milestones, the KPIs, the key performance indicators that the team I'm going to form is going to be held accountable to. And then I go into that market and I start building up a team. I find a property manager, show them the business plan, show them how well we're going to execute, phase 1, phase 2, phase 3 of acquisition, and then disposition of that asset. So they're on board and they have buy-in for that. We incentivize our property managers through a cost sharing program where if they hit certain, or not cost sharing, equity sharing program. So if they hit certain KPIs, then they get bonuses. For example, like if they hit an occupancy level at whatever 95 or higher, they get an extra percentage of rent or something like that. Or if they hit delinquency below a certain level, or if they hit what's another one we do? NOI. So if they hit an NOI target, if we say, hey, our NOI for this quarter is this much, that's the target. And if they hit that, they get an extra point of commission, things like that. So that's some of the ways I incentivize those property managers or those team members on the ground there. And then as far as holding them accountable, like I said, I set up the systems, and every week we do like pulse check meetings where we have our spreadsheet set up, and we get on a Zoom call just like we are now, and we go line by line. Here's the rent roll. Here's the delinquency report. Here's the income report. Here's all the KPIs. Here's our leasing reports. And we go over what's the problem with this. Here's the KPI, and here's the actual performance. Are we on track or not? If we're not on track, what do we have to do to get back on track? And a lot of people don't do that. A lot of people just kind of they close the deal and they throw it to the property manager and say Jesus, take the wheel. And they end up with very much mediocre performance. So I'm a lot more hands-on than most people. But our performance shows that as well. We tend to find stuff very quickly when we start getting off track. We can right the ship very, very quickly because we're having those weekly calls with our property manager. So, and property manager and or team members on the ground. So we have a separate meeting every week for our team members as well, like a level 10 meeting where we get together, we get a huddle. It's actually Thursday night. So tonight, 8 p.m., all the team members are going to jump on a call, and we're going to go through our scorecards and our KPIs that each team member is accountable for. And I think that's a big thing that, sets performing and effective teams apart than ones that are not effective is, the structure and the accountability of it.
Oh, that's awesome. And so, I'm going to have to put that property manager incentivization in my toolkit. That's really creative. How, when you say you give them a point, are you saying you give them a point for that month that they hit that KPI, or you're saying you're now boosting them to one more point for that remaining of the contract?
We usually do it like quarterly. So we because it's easier for math for us, is we'll set quarterly KPIs or targets. Like I said, the biggest ones are going to be NOI and occupancy are the biggest ones. So and then we use economic occupancy. So not just physically there, but physically there and paying, right? We don't want just warm bodies in the units, right? So those are the two biggest ones we do. And then if they hit an entire quarter of those, they'll get an extra point in commission off gross scheduled rents. So or gross rents collected. Nice. So if they were, and we write the contract where, say that their base commission is going to be 5% or something like that. So no matter what, they're getting 5%. And then if they hit these targets, they'll get, one for the NOI target and then one for the occupancy target. And that will give them, a 7% or 8% total commission.
Nice.
That's awesome.
That's pretty cool. No, I like that because then it's good to hold accountable.
Yeah, absolutely. And it holds them accountable and then also incentivizes them
exactly
to excel.
Yeah, no, I like it. I'm going to have to put that in my toolkit, man. Like I said. So then from there, let's see what else we can dive into. So you have awesome, processes in place like that. How are you time blocking though? Are you using VAs? Are you using assistants to help you navigate through your day? Because you do have other jobs.
Yeah, I am getting there. I'm on like my 10th virtual assistant. I'm still getting there. I'm at the point right now where I'm gonna have to probably hire an agency to help me get somebody that is really qualified and not just saying they're qualified. Because there's a lot of VAs out there that says they can do everything, but they can't. Yeah. But right now, I'm being in Hawaii. I'm kind of spoiled a little bit because most of my operations are East Coast time. So I'm getting up at like 5 a.m., crushing it between like 5 a.m. and like 8 a.m. And then I go to work. So
that's sweet. Yeah.
But once I get out here, that, I'm going to have to figure something out a little bit better.
Yeah. Yeah. If I
do have an assistant though. So we do have like a real, not a virtual assistant, but an actual assistant here on the island with us. And he's a college kid. Shout out to Giovanni if he ever hears this, but he is awesome. He's very tech savvy, an Excel wizard. So he helps us out a lot on due diligence, like a lot of like the crushing through the paperwork and everything like that. Excuse me. He helps us out with that a lot.
Yeah. So because you mentioned it, so I don't know if you read the book, Michael Hyatt, World Class Assistant, but highly suggest it. And then in that book, the company that he started with was Belay. I actually talked to them, and it is a significant price, but I think it's well worth it. I can't do it right now, but I will do it in the future. I'll tell you that.
Yeah, I will say, lesson learned there is, don't go on, Fiverr, Upwork, and just like, oh, there's this, person in for $4 an hour that's in, whatever country, and they're going to do everything for me. You're probably going to get what you pay for.
Yeah.
And so that's what we're at.
So, I mean, I'll just say they do like a $3,000 onboarding fee. And then from there, you through them, you pay for about $1,800 a month, which adds up to like $40 an hour, something like that.
$40 an hour. I got to quit my job and go do that.
Well, that's an executive assistant, you want someone to do everything.
Yeah.
Right. You gotta pay the price.
Yeah.
Yeah. Just throwing that out there. That's something actionable people can look into.
No, absolutely.
And get in there. Yeah, man. So then, German, what you got?
One of the things I wanted to ask you, man, is how are you running your numbers, especially that right now, with the situation that is going on. You're incentivizing, the people that you work with, the property managers and all that stuff, and of course they're bringing your properties to performing better. But how are you calculating those numbers, and not only that, but how are you raising the NOI, especially during this current situation?
So for running the numbers, like what specifically are you talking about? Like underwriting or?
Yeah, so underwriting, right? And you already have those incentives in mind. That is like, well, if they perform well, and obviously, I mean, you're gonna make sure that they perform well. How are you calculating those incentives into your numbers when you're doing the underwriting?
Oh, I just budget for assuming they're going to hit them.
Okay.
So if they hit them, good. If they don't, then that's just more money that we keep.
Okay, got it.
So, yeah, if the max that they can get is 7%, if they hit all the targets, I'm just going to put a flat 7% on there.
Okay.
So I don't get too far into that. But what was the second part of your question?
No, that was it. I mean, in based on the current situation, right? For the people that are trying to figure out, it's like, okay, the math on underwriting. How are you doing just to give you an example, right? To make the question easier. We're assuming, for example, that rents are not being raised next year, probably in the next 2 years. What are you doing to raise the NOI in the assumptions for the next couple of years?
Got it. Yeah. So especially like COVID and everything like that. So kind of two things we're doing. Let me think here. Okay. So as we go into our underwriting for acquisition, there are some things that we are doing. And again, this is very, very market based, because one thing that has taught me that I learned this year was like pay attention very, very much to your city and your state's local policies when it comes to like landlords and stuff like that. You hear those things like landlord friendly states or tenant friendly states. I never really paid too much attention to that outside of like evictions, like how long it takes to evict somebody. But holy crap, this last 6 months has been crazy. Like my Michigan portfolio is performing completely different than my Texas portfolio. So I'm paying a lot more attention to the local state level politics there and their policies to kind of dictate my lender or my reserves and my underwriting to what I can do, because that's guiding a lot of that. But things we're doing, so if it's in like a little bit of a harder market like Michigan and things like that, yeah, we're not doing any we're not budgeting or underwriting for any rent increases right now. We're keeping the vacancy pretty high. Probably I think the latest is we're sustaining like a high 80s pretty much throughout or at least that's what we're underwriting for, is like a high 80s throughout the rest of the next year or so. We're not adding any new income. So we're not adding any kind of new fees or anything like that. If it's existing, we're maintaining it. We're kind of in like the status quo where, if we're getting a $10 rub or a $15 rub, we're just going to plan on keeping that. We're not really planning on increasing that in the next year. We're going to try to, if we can, but we're not going to bet on it. We're not going to put in our pro forma that, we're going to do these things and the deal has to work because we do them, because we're showing that we need to be a lot more conservative, especially in those markets where, again, in Texas, it's completely different. People are paying their rent in Texas. And we're actually getting hitting rent premiums in Texas as well. So we hit our targets. Like in that deal, the last syndication we did, we're already in the 24-month mark of our pro forma, and we hit it in 5 months. And that's mainly because of the market that we're in is strong. The politics of Texas is very much different than Michigan. So they didn't get the same message from their governor than they did the Michigan governor there. So people are paying their rents. People are still working. The state didn't shut down like Michigan did. So we're being a little bit more aggressive in the Texas one. So what else we got? We got vacancy. So keeping a higher vacancy than we normally would, keeping no new additional income, and keeping rent growth pretty flat. Or at least like if we want to go have an increase, just don't increase it past inflation, like the 2 to 3% inflation. We're not doing like a 10% bump or anything like that. As far as financing and just operations across the board, we are keeping our reserves much higher than we normally would. The general, rule of thumb people benchmark is like 2 months of OpEx and debt service as your reserves, your reserve fund going into a deal. We're ramping that up to like minimum 6 months or 9 months or something like that. So when we close a deal, we have a lot of cash on hand, and that's something that we're going to do everywhere. Just because there's so much uncertainty of what's going on right now, we don't want to run into a situation where, we have a high burn rate and we're just burning through our cash through operations because we went through like another COVID round 2 or something like that. So I definitely encourage people to have much higher working capital or cash reserves than they normally would. Especially if they're going to agency, then they don't have a choice because they're requiring them anyway. So yeah. But if you're dealing with local lenders that don't necessarily require it, still underwrite where you're doing at least, I would say, 6 months minimum, like full operations, OpEx plus debt service right now until we get, the light at the end of this tunnel. That's the worst position for an owner to be in is, strapped for cash flow, because then I'll be there to buy it from you for a good
You're such a jerk. Hey man, so where do you see yourself next year, 2021? Where do you see it?
Crushing deals. We are, our team's really finding their groove. We just closed, like I said, we closed the 48 unit, or the 52, the 48. We got a 60 right now. So we're really getting into our stride of what this team is turning into. And 2021, I think we're going to do another double, right? We doubled our portfolio this year. I think we're going to double it again next year. Nice,
man. So how are you leveraging those partnerships, right? Because from what I understand, some of the deals aren't with just your core Tri-City team, right? They might be external. How are you leveraging those and making sure that they actually are a good fit?
Yeah, great question. We're still working that one out. This is this next deal we do, the 72 unit, is our first time not being the main partner of that deal, like the main sponsor of that deal, or we're actually partnering side by side with another group. The best thing is just be extremely transparent. One of our lessons learned on the last deal is assuming what the sponsorship team compensation is going to be. And that is, we found out that was very wrong. So the best thing to do is lay it out like day one when you're talking about a partnership, very, very clearly how each partner is going to be compensated, or maybe not each partner, how each role and responsibility is going to be compensated. That way, whoever's going to fit that role and responsibility, whoever's going to be sitting in that seat, doesn't matter. It's how that seat is going to be compensated for, deal finder, for KP, for whoever put up the at-risk capital, whoever is doing like the investor relations, whoever's doing, filling any of these roles, you assign like a percentage of the GP for that role. And then whoever slides into that role, everybody knows, okay, well, Bob's getting, 20% because he brought the deal to the table, and we all agreed that whoever brings the deal to the table gets 20% or whatever it is, doesn't matter.
Yeah.
As long as you agree to that stuff, what those compensation rates and what the splits are before you get a deal under contract. That was a big lesson learned from our last deal.
Gotcha.
Interesting.
Because you don't want to have a conversation where some guy thinks he's going to get 25%, and then you get down to doing your legal documents and you're like, no, bro, you're only getting like 10. And that's what, and that's what we had to do. Because we on our fault, we weren't transparent up front, and we just assumed that everybody knew this compensation structure. So lots of transparency, lots of communication, lots of laying down the expectations. And again, back to accountability. If you're going to take this hat, we're going to hold you accountable for that role. And this is the structure that we're going to put in place to hold you accountable.
Awesome, man. No, I love it. Especially, you're looking at other people and trying to fit that puzzle together.
Yep.
Cool. German, you got anything?
I mean, man, let me ask you this. So Oscar told you, ask you where you see yourself next year. Let me ask you, what are your goals? You're a real estate investor. You have your own podcast. You have your own meetup. I mean, you're active everywhere. You're active in the military. Where do you see yourself? What's your goal, right? Because you're everywhere. You're killing it, and people might be saying like, "Well, I don't want to get into real estate investing, into multifamily if I'm gonna be working like this guy," So what's your goal eventually, man?
Yeah, I probably work a little more than most people should. But I have a burning why, and that's what drives me. So go into the goal. I'm also going to be transitioning out next year. So I have that, burning in front of me. Like, I got to get all this done before this paycheck stops. Right.
Yeah.
So that's a pretty strong why, is to know that, you're taking the uniform off in a few months. Right. You know where it's at, German.
Yep.
Right. So that's if that doesn't motivate you, then I don't know what else will. But so my personal goal is, family driven, right? I got 3 kids, definitely very personal. Like I didn't have a, great childhood growing up. So I want to make sure that I'm a dad that's going to be there for my kids. And that's not for, being deployed all the time or being TDY all the time. So, and having the means to do things with them, provide them a life that I didn't have. So getting out of the military, doing real estate full time, and doing the work now. So when I do get out, I can choose to step back from my operations. I have the systems and the process in place to where if I want to take a couple of weeks off to go, take the kids and go to, Europe or something like that, I can do that. The systems, the business is going to take care of itself. But to do that, to be able to afford that, I have to put in the work now. Yeah. So that's why I'm driving full speed ahead over the next year or two to build this machine, and then I can take a step back and be there for my family, and then I can kind of come in and out as I need of the business.
Love it.
So let me ask you this: is multifamily your vision or your strategy?
Strategy.
Yeah. Okay.
So the vision. Yeah, so it's like anything. Like people said to me,
we've had people tell us that their vision is to own 1 million units, and we're like, okay, that's not my vision.
So then I would ask them why 1 million units, right? What? It's always it's always the means to the end. My goal, right? My vision is I am flying my Piper Mirage, which is a pretty nice plane. So flying my Piper Mirage, and I turn around and I see my daughter sitting next to me, my family in the back, and we're flying off to, whatever, the Bahamas, because I just got a place out there for the summer or something like that. Right. That's my vision. Right. Yeah. That vision ain't cheap. So I need a way to get there. And it's not necessarily going to be on my military, E7 paycheck, right? That ain't going to afford a Mirage. That's it's a $600,000-$700,000 plane. So, in order to afford that vision, I need a means to get there. I need a vehicle to get there to do this vision. And to me, after doing a couple different things, multifamily is the vehicle, is the only vehicle that's going to get me to that angle, to that vision. And then so I have my vision, I know how much it costs, and then you back into it. Okay, to be able to afford this vision in this lifestyle I want for my family, how many units? I already picked the vehicle, multifamily. How many rows in this bus need to be there, right? Well, I need about 400 rows in this bus. Yeah. So 400 units or whatever it is, I need to have in order to achieve this vision I have in my head, my vision board. And that's how I think of it. So multifamily is the vehicle, and I do have a number that I need to hit, but it's not the goal, right? The goal, that vision is, the thing it's going to do for my family, and the multifamily is just how I'm going to get there. So that's my take of it.
No, I love it, man. I agree. We try to ask questions like that because everyone has a different take on it, right? Mm-hmm. And for some people, it might be owning a certain number, right? That's what they love and see themselves doing all the time. Yeah. But mainly for the people that we have in our podcast.
So the counter to that is where, because I do this a lot in my day job. Because what I do is I do a lot of goal setting with the younger enlisted, right? So a lot of it's like, I want to buy this car, right? Well, why do you want that car? Well, so I can drive around and get out of the dorms and stuff like that. Like, well, the car isn't the goal. The goal is freedom, right? You want freedom. That's the goal. The car is quite literally how you get the freedom. So same thing with the people that want 1 million units, right? Like, why do you want 1 million units, right? Well, because I'll have enough cash flow to do whatever I want, when I want, with who I want. Well, then that's the goal. How you're going to achieve that goal is getting 1 million units. And the reason I structure it that way is because the why. Like I said earlier, I have a pretty strong why that gets me up in the morning, gets me driving, is because if that person that had, my goal is 20,000 units because it's a cool number and I'll make a lot of money. Well, is that number big enough for them to drive them to do through the crappy times and wake up in the morning and jump on planes and go do all this stuff and grind day and day and day? So what's going to happen is, maybe they don't hit 20, maybe they only hit 10,000 and they hit 10,000 units and they say, well, I didn't want 20,000 anyway, right? Because their why wasn't strong enough. But if their why was, I need to achieve this, and the only way I'm going to achieve this goal, like this lifestyle I want for me, my family, and this legacy wealth, this generational wealth, is getting 20,000 units, then they don't have a choice. They have to get 20,000 units. It's not, I'm going to do 10,000 and quit. It's like, no, I have this lifestyle, I have this vision, and the only way I'm going to get that is that 20,000 units. And that's what I see separates a lot of people between those high achievers and those people that are just like, where do they get the energy where do they get the motivation to keep crushing it day after day after day? Like the Eric Thomases and stuff like that, who I just channeled right now, is my ET. But he has a very good point. It's you got to put a why to that goal. Because otherwise you're gonna put a half-assed effort in and you're not going to achieve it. And then you're going to convince yourself that you didn't want that stuff anyway.
Yeah, no, I mean,
that's true.
You just spoke some truth there, man. That was deep, man. You must get all those little airmen fired up.
I do.
Go multifamily. Yeah, that's awesome, man. German, you got anything else?
No, man. No, I just dropped the mic. You got it.
No, yeah. I think that was a drop the mic, man. I love it.
No, I mean, for the audience out there, I mean, this is our coach, Jake and GINO. And this guy, I mean, seriously, I admire you, Vincent, for everything that you do. Every time I talk to you, man, you fire me up. I learn so much from you, from every conversation. So yeah, I mean, if this is the guy, that we listen to. and we always, every time we need something to move forward, we go to him. So yeah.
Yeah, man.
Oh, thank you. Very, very touching. And same for you. I don't know too many people that are brothers that are tag teaming this together that can stand each other long enough to create businesses and do this together. A lot of people are just you don't see many family like this doing it. So congrats to you guys for sticking it out there.
We're fighting right after this. All right. Hey, you messed up, bro.
No, I love it, man. I love it,
man. Yeah. So, tell the audience, man, where they can find you, everything, man. Let it go.
Yeah, we got it. So we have our Facebook group, Honolulu Multifamily and More. That's our Facebook group that we have. You can come on there and just talk real estate, come to our meetups. We are on Hawaii time. So if you're on East Coast, it's going to be pretty late for you. But if you're on the West Coast, it's good. So Honolulu Multifamily and More is our meetup. If you want to check out our website, it's tricityequity.com. And that's where you can come check out what we have going on, our portfolio, what deals we have coming up, our strategies and things like that, and just our insights of what we do. So that's where you can hit us. If you want to email me directly, connect@tricityequity.com.
And like I said, he's a coach at Jake and Gino. So join Jake and Gino and request to be coached by Vince.
Yeah. So and Tri-City Equity Group is crushing it. So we'll stay on the lookout for what you guys keep doing that, man. But yeah, thank you for coming on, and we really appreciate it. For all the listeners out there, give us a 5-star review. Show us some love, send some messages, let us know what we could do better, what you do like, and we'll go from there. Thank you guys. Thanks, Vince.
Awesome. Thank you.